Hey traders, Chris Vermeulen from thetechnicaltraders.com. A little while ago, I promised I was going to do an educational video talking about my favorite chart time frames, talk about some moving averages that I kind of live and breathe by, and also the Fibonacci retracement, Fibonacci extension tools, how I kind of go about and use all these. So I'm gonna recap on these and show you what I do and a little bit of why I do it, and show you some examples, and we can go from there. So taking a look at my charting platform, I've got 3 charts set up. Now on the right hand side top, this is the daily chart. I'm going to be showing you everything on the SPY for this video. But more or less, the daily chart, I like to use the 50-day moving average, which is the simple day moving average of the daily chart. I like to use the 20-day, which is the pink, and then this light blue I use as the 5-day moving average. And you're going to notice when the market's in a strong uptrend, the price tends to stay at or above the 5-day moving average. Is a high momentum play. You can see how it can string up there. A really good example is actually chart of bonds. If you look at the chart of bonds, has some very strong trends. Usually stays under the 5-day in most cases, and under the 20-day. That's kind of the definition of a really strong trend. So bonds right now trading at resistance, and we'll see where that goes. But let's focus on these key moving averages. Now, this is the time frame that I like, the daily and these moving averages. I also like the 30-minute chart of just regular trading hours. So don't have it set to show you 24 hours pre and post market. You can set your chart time frame to just be from 9:30 to 4 with the ETF. And the 30-minute gives you a really nice view of price action over several days. So you get to see intraday price swings, and the 30-minute gives you nice chart patterns that have some pretty good potential. Example, if you were to use a really short time frame, you wouldn't get nearly the same potential. And it's not about trying to do a lot of day trades. It's about trying to find key turning points. For example, I typically don't include a washout low in the market, but I'll use the first kind of pause or pullback here. You can see you got a rally up. We had the first pullback. We broke one high, 2 previous significant highs. We also broke another one. So this is a nice, strong impulse wave changing the trend. And then we measure this from where it pulled back to as like a bull flag. You can carry that forward. It gives you an idea of where price should go. 618 is usually the first level where it's going to probably struggle. Usually if it pauses and tests that level, then usually it's going to go up and hit this 100% measured move line. So 100% based on this initial momentum. So this happens over and over again on all kinds of time frames, and the markets can be broken down into much shorter time frames going forward. I mean, we'll go back on the 10-minute chart here below and show some more settings. But the nice thing about the 30-minute chart is you get a really good view of the type of oscillations and range that the market has. Is price action kind of broadening? Are the ranges getting bigger? Is volatility picking up? What type of pattern are we getting on the 30-minute chart? Because a lot of times those patterns are going to play out, and you're going to see those really unfold on the daily chart and give you some really key insight there. So I like the 30-minute chart with the same moving averages. Now I've got this moving average here overlaid. This is a 30-minute chart, but I overlay what is the 50-day moving average onto it. So this blue line is the same as this blue line, roughly at the same price. This one is, for example, 650 moving average. Let me put that back to a simple moving average, more or less 650, and that is equivalent to a 50-day moving average. So 650 30-minute charts is equivalent to this this chart here. And then we go on, the pink line is the equivalent to the 20-day moving average. And then we got this blue line here, which is the 5-day moving average, which typically will act as support when you're above it. Eventually, when you break it, it becomes resistance. Sometimes the markets just get noisy and they just chatter through everything. That's just the way trading goes. But I like to try and keep these key moving averages all in sync across my charts. That way I get an idea of where there's critical support on the daily chart, and I can see how price is moving towards it on the intraday chart, on the 30-minute chart, to see if we're going to get some type of test of it and then start to reverse or sell off and come down to the 50-day where it's going to try and find potentially support for some type of intraday bounce or potentially a more significant bottom. So I like to do that. The other chart I like to look at is the 10-minute chart. And I use the 10-minute chart. I use the 24-hour chart. So I can see post-market, so after hours, and then I can see pre-market trading. And then obviously these high volume times are from 9:30 to 4. So you get a much larger picture of where price is going, and it gives you an idea of overall patterns in this market. So for example, if we want to just look at these this type of price action, let's just zoom in over here. We've got more or less, we got actually we can just go back a little bit further. Let's get some bigger price patterns here. More or less, we can go back to these levels here and use Fibonacci extension to get an idea of where price may end up going. Now, typically we're going to start with some smaller patterns and then they build into bigger patterns, and eventually things can get out of control and there's not a whole lot of insight there. But if we were to take a recent high and then we go back to this recent low, we see the market rally up and then it starts to sell off. So this looks like it's the first kind of move down. We've got a bear flag and then it starts to head lower. That gives us an idea of where that next momentum move is going to be. So you can see here you have the first sell-off, you had the first kind of strong reaction kind of back up, and then we've got the 618 level, we got the 100% measured move, and that gives us kind of an idea of where that downside support is going to be as it starts to fall during that day, where we could find technical support and start to bounce. Now eventually it goes in and forms a larger flag, and so you start this larger flag. Now it could be used with a larger pole. So you could do the same thing. You take the high, you go to this new low, and you move up to this recent high, and it'll give you an idea of where the next downside target should be. Now we came all the way down. We kind of gapped below the 618, kind of came back up, filled this gap. If you follow my work, you know gaps tend to get filled, almost always get filled on the SP 500. So it came up, filled that gap, and then it came all the way down and hit this 100% measured move. And then, of course, there's a huge washout low. It doesn't mean it's going to reverse right at that level. It just means that's where momentum's taking us. Sometimes there's so much momentum and there's panic in the market, especially to the downside, that you get these washout lows. Everyone gets shaken out, and then the market reverses back to the upside. So if we were to just after that washout, we get some initial big pulse to the upside, we can get an idea of where this next move may be. For example, I don't use washout spike lows typically. Usually I'll draw them and get an idea, but typically you want to use a more conservative play. I'm always looking for the smaller, the easier target for the market to hit. For example, if I was to do down here and go up here and the market consolidates and pulls back over here, this is in overnight trading. More or less the market would work itself up over here in overnight trading. The market opens down over here. So this, if you were just look at regular trading hours, you'd see this market pull back and then it would open up down over here and put this low in, this bear flag. So we're going to go from that low and it would give us an idea of where that target should be based on that washout, exhaustion, extreme move. And you can see we never went up and hit that 100% measured move. Now, if you were to actually use the conservative play, which is kind of where the next rally started from, not so much down here, but over here, you get an idea. Use the high, you come back to this low, you carry it forward, you get an idea of where that resistance and target is likely to be. You can see price came up, it blew through the 618, came all the way up to the 100%, eventually lost its momentum and then rolled over. So you always want to use not the spikes, but the next conservative pullback or rally, depending on which direction the market's going, for your targets. Now, for example, the market now has a big move to the downside, a lot of volatility, and then it rebounds back up. We can use Fibonacci extension to get us a new pattern here. So we got this sell-off. We come all the way down here. This looks like some type of capitulation sell-off low. We're just going to use multiple bar points where it hits, so through here and over here. We're going to take that as the low, and then we're going to take these over here as the highs and carry that forward. And it's going to give us an idea of where there's going to be the next two price targets, the 618, which then eventually broke through, came back up, tested, and then it came all the way down to the 100% measured move. And so we can use these over and over again, especially when you look at breaking patterns down, you're going to notice a lot of these patterns, all these little bull flags, they kind of play out and give us a big picture of where price is going. Now, if we were to look at the size of all these rallies and pullbacks, which you can use Fibonacci to work your way up, and then eventually we start to have a breakdown. So now there's downside Fibonacci targets going on. So if we were to look at this overall bigger picture, we've got this A, B, C correction. This is really what cleanses the market. It's the break of this low where people start to panic right in here, really start to panic. They get washed out of their trades, they get out, and that's usually where the market puts in a significant bottom. And when you look at this overall pattern, this is a nice big bull flag, and price here is channeling to the downside, kind of working itself down. And if this puts in a bottom, we're going to see a much higher upside move. So based on these lows here, we got a rally all the way up to here, and then we're down at this low over here. This gives us an idea of where the SP 500 could go over the next several days here. You can see upside potential from where we are down here is roughly about 4% to that level, and then all the way up to potentially 6.5% to the upside. And that would be a very balanced move. Takes a couple weeks to the upside, a couple weeks consolidation, a couple more weeks to the upside. So that's kind of what we're looking for, hopefully, in the markets in the near future, but how you can use the Fibonacci as this way to find upside targets to be pulling money off the table. If you're using a 10-minute chart, or this is the same for the 30-minute chart, or really any time frame, daily chart as well, you can use it to find levels to pull money off the table. Now, the Fibonacci retracement tool is really powerful if you were to take you want to know where this market could find support. So we do know there's a 50-day moving average right at this level on the other charts, on the daily chart. So it is coming down to a significant support moving average. It's had a nice ABC correction, which is good. It cleanses the market. But we can grab a low here and use a Fibonacci retracement tool, and you go up to the high, and you carry that forward. And typically we're going to be looking for this market to find support somewhere, ideally between the 0.38 and the 0.5. So somewhere between the pink and the purple line is the ideal kind of spot for a pullback. You might get some type of washout low that spikes down over here, but we should be starting to run out of speed here. This is typically where you're going to find a rally start from, is usually the more or less 3/8 and the 0.5% of the move. And what 50% move means is it rallied up 100%. This is considered a 100% move, and it's pulled back 50% of that distance. And so that's usually acts as a pretty good support level for price before it starts to go higher. And of course, we can do this on all kinds of different time frames. Let's just go over to the the daily chart, and let's do a Fibonacci extension here. We can take the low on the daily chart. I'm going to use a closing price, not so much the wick low. Although you can use both. I'll typically draw both on there just to see where they are, and I can box them in. I can do that and show you. But more or less, we had our first real significant rally up that had like a kind of a blow-off exhaustion island top. I remember when this happened and talking to subscribers about it, how it was a very bearish sign short term, and then the market crashed after that. But we got the first real clear kind of pullback in the market. And so we take the high and we take this low, we carry it forward of where the market should go and find resistance. So the market rallied up, had its first consolidation, went all the way up to the 618, went into a multi-month consolidation, and then it continued to break out and went up. And just really a week and a half ago, hit that 100% measured move, and we're seeing a little bit of pullback from that level. Now, as the market evolves, you get these bigger consolidations which match the size more or less of the flagpole. So you can start to get bigger patterns within it. So if we were to look at the next bigger pattern for the SP 500, we take the low, we go up to where it started this much larger pullback, and we go there and we can carry that forward. And we can squish the chart down to get an idea of where that upside target is. And I'll just get rid of this other one so it's cleaner on the chart. But this shows you where we had the rally, the pullback, and we're working our way up to the 618. This is kind of the next short-term measured move. I think it was even on our 30-minute chart, it was pointing up to this area here, which the market might consolidate for a bit. But overall, it's showing that it's got much more upside potential from where we are. We're at the 50-day, We've got that 4% and change, 4.5% we talked about, which lines up with the 10-minute and the 30-minute chart pattern. So that's definitely going to be a significant area where the market might pull back after that for a bit and consolidate. But we are looking for a potential run here still of this overall large pattern of around 17, 18% on the SP 500 to the upside when you look at it from that time frame. So definitely huge upside potential. This market could catch a lot of people off guard and have some huge exhaustion blow off top. A big move. We've seen this happen before. You look at these moves over here. This here was a 19% move. It goes to a kind of a multi-month consolidation and has a huge run. We're kind of doing a running consolidation here, a running correction where it's kind of chopping its way up in this kind of channel. It's kind of, instead of it rallying up and then flagging down and taking a breather, it's actually running up and it's just shaking people out as it's going up, trying to get everybody out. And eventually it could pick up speed and really start to hook up and rocket up to those levels. And from there, if we have this type of move, it's going to lead to a very strong pullback in price. Very similar to what happens over here. The market consolidates, eventually just starts to run away, has a big gap up and some type of reversal bar, and then it's done for a three-wave correction, which is what happened there. And of course, you got to break this high eventually to really kickstart that new trend. You can see we had a nice rally up, and then it consolidated here, and we could probably even throw Fibonacci on that. We got the lows, we got the high, we got the low. It'll bring us right over to a previous high over here where price came up. It kind of tagged this 618 for a while, then finally popped through it and pulled back to it as support, eventually worked itself up there. So you can break the market down into all these kind of little fractals and use different time frames. And when you have the shorter time frame price patterns align with the daily chart levels as well for some of these shorter term patterns, you know they're probably going to act as a pretty significant resistance area. And then when broken, you can look at the bigger chart patterns for where the kind of next major upside leg is for the index or stock or commodity that you're looking at. Let's go and take a look at over at gold. I know a lot of people want to see what's going on with gold. If we take a look over at the gold chart, silver chart definitely is clear as well. Let's go back over here. This is a very big, obviously we've got this series of bull flags happening on the gold chart. We can take these lows and go to the high, go to this recent low. It'll tell you where that next upside key target is for gold. So it ran up, started to pull back as it would break out through kind of this falling, not a very straight line, falling channel. You can quickly draw this analysis and say, okay, well the next upside target is going to be somewhere right in here, and then the next one's going to be right up here at this 100% measured move. And it ended up pausing there, and then it popped and broke and ran to the upside and continued to go higher. And of course, you can use these patterns over and over again. You can take the low to this high, down to this low, carry it forward to see where that next target is. And you can see price came up, it blew through the 618, ended up going all the way up to this 100% measured move. And more or less, a bull flag pattern like this is known as the halfway point. So you get it up here, you get the halfway point, and you're looking for the second half, which is 100% of this first leg up based off this low. So you can do that over and over again. You can take these patterns, you can go from a low kind of to a high to a low. It gives you these targets. Eventually you've got this very clean low over here. You've got this high over here, this new low. It'll carry you forward to where price is going to go. It ran up to the 618, started to pause and correct, and we had the COVID kind of washout crash in there, creating just a lot of noise, but eventually ran all the way up to the 100% measured move, consolidated, and then started to run up. And if we take this measured move from the low to the high, back over to this low, it tells you where gold should run to, which was 618, and then all the way up to the this 100% measured move, which eventually had a blow off top, surpassing it, having a very strong crash to the downside, killing that momentum. And when I talked about this on the SP 500 a minute ago, that when you get these really strong blow off tops, they end in a very strong correction. Bitcoin's in the same boat, going parabolic. It's going to eventually end in a very, very gnarly way. You never know when. And right now we're seeing gold correct in this kind of stair-stepping action to the downside. Let's look at this big pattern here for a minute. Let's use a Fibonacci retracement and figure out where this long-term support level could be found for gold. So we're going to grab the Fibonacci retracement tool. We can go, we'll draw a couple of them here. We got from the low all the way to this high, we carry that forward. This is the zone that we're looking for gold to find major support between the 3.38 and the 0.5. This is the ideal window where gold comes down and finds a bottom. Now I do feel like gold could end up washing lower and coming down and going deeper. I still think there's some more downside potential there, but overall, it's in this sweet spot. As a long-term investor, this is definitely taking a lot of risk out of here. Instead of paying $2,000, $2,100 an ounce, you can now pick it up for $1,700. I think it could go all the way down to $1,640, $1,630, potentially spike down to $1,600 very as a washout type low, and eventually put in a bottom and start to go higher. But it's in that sweet spot as a long-term investor that a lot of energy has been cleansed and taken out of this market. You're picking it up at a discount at major support, huge trading volume through here, lots of trading volume through here. It's a 38, 50% retracement level. This is still a huge bull flag pattern pointing to much higher prices. And we can look at this big pattern as where is the upside potential? And we can use Fibonacci extension saying, if it finds support in this box somewhere, we can take this low, we can go up to the high, and then we can take this current low that it's at. We could go conservative and say, okay, well, it might drop down to this level, or we could use here. It doesn't matter. I'll go conservative because I like to always go on the conservative side and get out just before something rolls over versus being off by a couple pennies and watching it crash just before your target. Let's squish this down, and you can see where gold upside potential is based off this low here. Right now it's trading at this level. So from here, we're looking at a potential 26% move all the way up to a 46% move or so going forward. So this pattern, this size of this bull flag matches the size of this flagpole. And maybe if we change time frames, you can see that a little better. Technical analysis is a lot of art. It's a mix of art and science. But you can see here you've got this big run up, and now we got this big multi-wave correction to the downside coming into the sweet spot. Let's see what the monthly chart looks like. It's nice to jump around to different time frames. If I was to clean the chart up, you can see this is up. I don't have the chart going back far enough, but obviously we've got a move up here, and then we've got a major this is a big consolidation, big resistance area right across these tops. This is where it started to break out and run. You could use either this low as a very conservative level for our Fibonacci extension. So you could go from here to here to here. That'll give you that set of upside target. Or you could go from the previous one that took place back here. Go from here all the way to here and back down to here. And that's going to give you two potential windows of upside targets for where we're looking for resistance or some type of multi-month pullback. This is the monthly chart, so keep in mind it's going to rally up to this level. You could see something like this. This is a 1, 2, 3, 4 month. You could argue it's a 5-month consolidation before it rallies. So that's half of a year right there. If it gets up there, that it could just pause and chop around before going higher. The next upside target would be somewhere up here, 25, 2600 to the upside. And that could be a fairly significant top that could take a year. Right now we're like 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. This could very easily be a year-long pause consolidation before really putting in a bottom and starting to head up to these levels. And again, that's if we use the Fibonacci retracement tool, we can go here on this conservative one. On the conservative level here, it's already come back to the 50%. So it's already at that 50% starting to bounce. If we go from the more extreme level and carry it forward, I'm going to get rid of this other one so you can just see it clear. At the other extreme level, we came to the 318, kind of came right between 318 and this 50%. So there's still potential more downside depending on where you go on this chart. But these are the upside targets and downside moves. That's how you get a gauge on things. So hopefully that gives you an idea of how to use Fibonacci extensions, retracements on the charts and different time frames. and using these key moving averages to act as resistance levels, like the 20-day and the 50-day, very significant resistance levels for short-term traders. For the index trading, I like to look at the 5-day for short-term momentum trading, where price will typically be trading, kind of try and stay above the 5-day. This is actually the best example, but a lot of times you get these strong moves, and in intraday, you'll see these pierces through the 5-day, but by the end of the day, it's usually at or above again, and that's the key, is knowing when it's going to close below the 5-day, because when it does close below the 5-day, you typically see price drop very quickly from the 5-day down to the 20-day. 20-day is kind of the next level of support going forward. Anyways, hopefully that gives you some insight, and take care. Talk to you soon. Bye-bye.